Are you thinking of buying longer dated Treasury notes and bonds? And if yes, do you know how they work? Hello members and super savers, I hope you're having a good week. As rates on Treasury notes and bonds move higher, I know that some of you have already started adding or are considering adding longer dated Treasuries to your fixed income portfolio. I also know, based on some of the messages we've seen, that there is a bit of confusion around how longer dated Treasuries work. Longer dated Treasury notes and bonds do differ a bit from shorter dated Treasury bills. So here's what I'll be covering in today's video. 1. What's the difference between Treasury bills, notes, and bonds? 2. How do the interest and principal payments on longer dated Treasury notes and bonds work? And 3. What's the difference between the interest rate and the high yield at auction? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. In my mind, there are 3 main differences between Treasury bills, notes, and bonds. And these main differences have to do with their term or time to maturity, their auction frequency, and when interest is paid. As many of you already know, Treasury bills come with terms of 4-week, 8-week, 13-week, 17-week, 26-week, and 52-week. Most Treasury bills are auctioned off every week, with the exception of the 52-week T-bill, which is auctioned off every 4 weeks. The Treasury also auctions off a 42-day cash management bill, CMB for short, on a weekly basis. And from time to time, it will auction off CMBs of different maturities that do not follow the normal Treasury auction schedule. Check out this video here to learn more about Treasury bills versus cash management bills. I've linked it in the video description below for easy reference as well. For the purposes of this video though, the important similarity between T-bills and CMBs that I'll focus on is when interest is paid on T-bills and CMBs. It's paid at maturity. Now, let's move on to how Treasury notes differ from Treasury bills. Treasury notes have terms of 2, 3, 5, 7, and 10 years. Most Treasury notes are auctioned off monthly, with the exception of the 10-year note. The 10-year note has a new issue auction every quarter, so in February, May, August, and November. The Treasury refers to new issue auctions as initial offerings. In addition to these new issue auctions or initial offerings, there are reopening auctions the other 8 months of the year. We'll get to the interest part shortly. As some of you may recall, a reopening auction is one where Treasury Direct sells additional amounts of a previously issued Treasury security. The reopened Treasury security has the same CUSIP and maturity date as the previously issued Treasury security, but it has a different issue date and usually a different price. And of course, because it was sold later, but the maturity date stays the same, the remaining time to maturity will be shorter than it was for buyers at the previous auction. Because such a reopened Treasury security has a different issue date, it also has a different price. That's because the price is based on the new issue date and therefore also based on the prevailing market conditions and expectations at the time of the reopening auction. And the new price will also reflect the shorter remaining time to maturity for the reopened T-bill. Treasury notes, as well as Treasury bills and Treasury bonds, can have reopening auctions. It's just another way for the Treasury to raise money by selling additional amounts of a previously issued security. Okay, that was auction reopenings. Now, let's move on to the third main difference between Treasury bills and notes: when interest is paid. Whereas interest on Treasury bills is paid at maturity, interest on Treasury notes is paid every 6 months until maturity. More on this shortly. Let's wrap up Treasury bonds first. Treasury bonds have the longest maturity, with terms of 20 years and 30 years. Like Treasury notes, new issue auctions or initial offerings of 20 and 30-year Treasury bonds also happen every quarter, in February, May, August, and November, with reopening auctions the other 8 months of the year. You can think of Treasury bonds as very long-dated Treasury notes for the most part, because they basically have the same features as Treasury notes, including the fact that interest on Treasury bonds is also paid every 6 months until maturity, just like for Treasury notes. So let's talk a bit more about how this actually works. For our illustration today, I'm going to take the example of a 5-year Treasury note. But do keep in mind that the same general principles that apply to interest and principal payments on Treasury notes also apply to Treasury bonds and other types of bonds as well, for that matter. So let's say that today we invest $10,000 into a 5-year Treasury note. To keep things simple, let's assume that the face value or par value of the Treasury note is also $10,000. Do keep in mind that this is not always the case. Sometimes the price you pay for a bond may be less than the face value or par value. And sometimes the price you pay for a bond may be more than the face value or par value. But at maturity, regardless of the price you paid, you will typically get back the face value and only the face value. So let's further assume an annual interest rate of 5% to be paid out every 6 months until maturity. This means that every 6 months for the next 5 years, we would receive an interest payment of $250. So over 5 years, we would receive a total of $2,500 of interest payments. That's $250 of interest every payment period multiplied by 10 payment periods. In other words, 2 half-yearly payments per year for the 5-year term of the bond. And after 5 years, our Treasury note would mature. At this point, we would receive the $10,000 face value or par value of the Treasury note back. This means that over the 5-year period, we would earn $2,500 on an initial investment of $10,000. Now, let's use a recent auction to show you how to apply these concepts in real life. Because we used the 5-year Treasury note in the previous example, let's stick with the 5-year Treasury note here as well. Here are the results from the most recent auction of the 5-year Treasury note at the time of this taping. As you can see, this 5-year Treasury note was issued on October 31st of this year and will mature on October 31st, 2028. The interest rate is 4.875%. Here's what this interest rate of 4.875% means. Let's assume that in October, we purchased $10,000 face value or par value of the 5-year Treasury note that we just showed you at auction. Do note that I haven't told you yet how much cash I actually paid to buy this $10,000 face value or par value. More on this later. So, every 6 months for the next 5 years, we would receive an interest payment of $243.75. Multiply this $243.75 by 2, and this gives us $487.50 of interest earned on an annual basis. Translating into this interest rate of 4.875% on the face value or par value of the note, the same number that's shown here under the interest rate column from the table before. Going back to this illustration now, after 5 years, our Treasury note would mature and we would get back the $10,000 face value or par value. Here's the thing though, what if in October we only paid $9,989.47 for this $10,000 face value or par value? Well, in this case, what we would be earning would actually be more than this interest rate, because in addition to these interest payments that we'll receive every 6 months, we'll get back an additional $10.53 at maturity. That's this $10,000 face value or par value minus our original purchase price of $9,989.47. And that's what this 4.899% number in the high yield column represents. The interest rate here plus the additional amount we'll earn if we hold to maturity, because the purchase price of this note was less than the face value or par value of the note. And if we click on this note's CUSIP here, this is the screen that pops up. Scroll down and we can see that the purchase price of $99.894701 is indeed less than the $100 face value or par value of this note. Now, if we go back to this auction results table, we can see that the high yield column is higher than the interest rate column for all of these recent auctions. This means that the purchase price at auction was less than the face value or par value of the note, that the buyers are earning more than just the interest rate if they hold to maturity. If the high yield column and the interest column are the same, it means that the purchase price at auction was the same as the face value or par value of the note. So the buyers are earning just the interest rate, no more, no less. If the high yield column is lower than the interest rate column, this means that the purchase price at auction was more than the face value or par value of the note, that the buyers are earning less than the interest rate if they hold to maturity. And the same principle applies to Treasury bonds. If we go to the auction results table for the recent 20 and 30-year bonds, we can see that there's also a high yield column and an interest rate column. It's also important to keep in mind that unlike with Treasury bills, with Treasury notes and bonds, accrued interest may sometimes come into play. Take a look at this video here to learn more about what accrued interest is and how it works. So, what do you think? Are you well versed now on Treasury notes and bonds? And are you interested in a video tutorial on how to buy Treasury notes and bonds at auction with Treasury Direct, Fidelity, Schwab, or one of the other leading brokerage firms? Drop us a comment below and let us know. All right, members and super savers, as always, I hope you enjoyed this video and learned something new. And if you did, I'd love to invite you to continue to support our channel through membership so that we can keep producing one-of-a-kind, objective, sponsorship-free videos for you and for our super saving community. Come for a chat at our next live member Q&A on November 17th at 5:30 p.m. Eastern Time. And check out our latest member, Muni, and corporate deep dives. Take a look at this video here to learn more about Diamond NestEgg membership, or visit our channel page or the join link in the video description below. See you again very soon with more brand new wealth building content for your financial journey.